Hello friends, a warm welcome to this new chapter of a CFA level 2. We are talking about fixed income instruments here, and the chapter name is Arbitrage Free Valuation Framework. Right? This is part of our CFA level 2 curriculum. Now what do we mean by arbitrage free valuation? To understand that, let us first understand what is arbitrage. Let's say there is a bond B which is selling in two markets, right? Market 1 and market 2. Now, this bond B has a particular credit quality. For example, let's say it's issued by a particular issuer. Let's say that is ABC. This company or this entity has a certain credit quality or credit rate. This company has a certain credit rate. The tenor of the bond is particular, right? Tenor may be n years, coupon may be certain thing, coupon may be C, etc. etc. So this bond's qualities are constant. But in this instance that we are taking, there is a surprising thing that is happening. What is that surprising thing, friends? In market 1, this bond is selling at $105 on par, right? And in market 2, this same bond is selling at $102 of par value, right? Now friends, same bond selling at two different prices. Now some investor, smart investor, who is looking to find an opportunity where there is return but there is no investment of money. There is return but there is no investment of money. This kind of an investor who is looking for return with no money investment will latch onto this opportunity instantly. How? Let's see, friends. The investor, let's say I, would borrow money, buy this bond B at market M2, buy this bond B at market M2, sell it at market M1. Now the margin with this investor in this deal is M1 price minus M2 price, right? This is equal to 105 minus 102 equal to $3, right? Now when does this investment make sense? Obviously, if the rate of borrowing is less than the $3 margin, right? Let's say the person borrowed 102 at a rate of 1%. That means the person had to pay $103.02. Now the net margin will be 105 minus 103.02. This is basically principal amount plus interest amount, right? So this becomes 1.98, right? This is the net earning of the investor for this investment provided the rate is 1%. Now this kind of a transaction, you do not invest your own money, you just borrow a money and you invest in the low priced market, buy the asset and sell it in the high priced market and take off the margin, pay back the interest rate which you took the loan on. This kind of a transaction, as we know, is called arbitrage, right? Now we are talking about arbitrage free valuation, which means this kind of an opportunity does not exist, which means the law of one price persists. So what is the law of one price, friends? The law of one price basically says that birds of the same feather flock together. Okay, this was the English version of it. Now let us talk about the finance version. Basically, if two assets are of the same quality, in every way, in risk characteristics, in return characteristics, in liquidity characteristics, etc., then their price will be same. Price will be exactly the same. exactly the same. There will be no difference between the price of these two assets because their quality is exactly the same. They will sell for the same price, which also implies that if the same asset is there, selling in two different markets, M1 and M2, then obviously the selling should happen at the same price. This is what law of one price says. Which means an opportunity like this, that a bond B is selling for 105 in one market and 102 for another in another market, this kind of an opportunity is not present, right? But according to the law of one price, this kind of an opportunity should not be present. And in actuality also, such opportunities, if at all are there, are very rare. And if you take away the cost of borrowing, if you take out the cost of borrowing, which is interest rate R, then many of them become actually useless. The cost can be greater than the margin most of the times, or many times at least. So largely this law of one price is quite valid, friends. And we will go by this basis only, that in these markets there are not really any arbitrage opportunities present. And we are talking about a fixed income market here because we are talking about fixed incomes segment. So fixed income markets, arbitrage opportunities are not at all present. If at all they are present, if you take into account the interest cost and all the costs of transaction, the trade is not actually valid, right? So this kind of a market situation exists. Now in this kind of a market, in level 1, we have already done valuation of bonds. We have already done valuation of bonds under constant yield curves, right? Constant yield curves means the spot rates are given. So let me plot it here. 1 year, 2 year, 5 year, 10 year, and these spot rates are plotted like this, right? This is what was the spread curve this is what was the yield curve or the spot curve, right? Based on which we valued the bonds, right? So let's say we have a 5-year bond. And this bond would be discounted in terms of spot rates of year 1, year 2, year 3, year 4 and year 5. And these spot rates Z1, Z2, Z3, Z4, Z5, they will be constant values, right? We are using definite constant values here. We are not assuming things like Z5 could be 10% also, it could be 8% also, and it could be 6% also. Z4 could be 12% also, could be 10% also, could be 8% also. These kind of assumptions we are not taking while valuing the bonds in level 1, right? But in level 2, here, we will be accounting for these kind of futuristic probabilities, right? Because the future is obviously uncertain. We do not know what the future interest actually is going to be. We can just make a few good guesses that the range can remain between this, the volatility can be this, the higher probability is this one, the lower probability is this one. Like this, we can make assumptions and make our valuation prediction based on those assumptions. That is the best thing we can do. Valuing based on constant rates is not actually how the market functions in reality. It functions in terms of probabilities because the future is probabilistic. It is not certain at all, right? The forward rates imply certain spot rates. These like Z2, Z3, Z4, Z5, these are spot rates of the future which are being concluded by the forward rates, right? Now these forward rates, we are assuming that they are going to predict exactly what the future forward rates are going to be in level 1. But actually it may not happen. There are probabilistic scenarios involved in there. In level 2, friends, what we'll do is we will use these range of values, probable values of interest rates of the future to value the bond. We will learn how to do that, right? So let's get on with it. Now, arbitrage opportunities, if they exist, are generally of two kinds. One is called the value additivity and the other is called the dominance. So let's understand both of them. First, let us understand what is value additivity. Let's say there are two assets, asset A and asset B. Asset A and asset B, okay. Now, asset A is a zero coupon is a zero coupon risk-free bond. Risk-free bond that is priced at $95 on par, right? Asset B is a collection of 100 of these bonds that has a portfolio value. The portfolio value is $9,700, right? Now, here lies an arbitrage opportunity in terms of value additivity. Why, friends? Because asset A is priced at $95. If you multiply this by 100, you actually get $9,500, not $9,700, right? So what you do? An investor can easily make use of this opportunity, friends. How? By selling the higher priced asset, that is asset B, and buying the lower priced asset, that is asset A. So an investor, she can sell the portfolio B for $9,700 and buy 100 numbers of asset A for $9,500. Now this will result in a margin keeping of $200, that is $9,700 minus $9,500. So this is going to be the net margin for the investor indulging in this arbitrage transaction, in this assumed arbitrage transaction. Now the second kind of arbitrage opportunity that is there is called dominance. So let's see what that is. Now what is this dominance variant of arbitrage opportunity? Let's see, friends. Let's say there is an asset C and there is an asset D. Now let's assume they are bonds. They are bonds of the same quality. For our example sakes, let's say they are zero coupon bonds and are risk free. They are zero coupon bonds and are risk free. Now let's say asset D is priced today at $100 and the payoff in 1 year is $110. And for asset C is priced at $50 and the payoff in 1 year is $52. Now friends, here lies an arbitrage opportunity. They are both bonds of same quality, right? So their payoff should be equal, but here it is not. If you multiply two assets of C, you are getting 2 into 52 as payout after 1 year. This is equal to $104. This is less than $110 which you are getting by investing in asset D. So this kind of an opportunity is also an arbitrage opportunity of the variant dominance. How do we make use of it? Now friends, in this example, C is the overvalued or highly valued asset. D is the comparatively undervalued or low valued asset. Now if some investor wants to take advantage of this kind of an opportunity, what she should do? Obviously sell high and buy low, right? So the investor can sell 2 units of C, get a cash flow of $100. 2 units of C will give her $100 because each unit of C is $50. Now with this cash, buy 1 unit of D. Now this is happening at t is equal to 0, that is beginning of the year. Now at the end of the year, that is at t is equal to 1, there will be a cash inflow. There will be a cash inflow of $110 because of purchase of D. And there will be a cash outflow of $104 because of selling of C. Now the net impact will be plus 110 minus 104 is equal to $6. This is an earning without any investment, right? Because just the sales proceeds of C has been used to buy 1 unit of D. So there is no investment here, but there is an income. So this is an ideal example of arbitrage opportunity. And this kind of an example where two different assets are giving differentiated returns despite being of the same quality. This kind of an opportunity is called dominance. Its difference with value additivity is, in value additivity, we are looking at, in case of value additivity, we were looking at n number of units are not of equal value as the sum of n units, right? So the asset was the same. We were looking at them individually and in combinations. The difference was there in the price of a combination and the individual asset when multiplied into the same volume. That was the difference. Here we have two different assets of exactly same quality being priced differently. So this is the difference, friends. In value additivity, we are looking at the same asset once as individual asset and in the second case as a combination, and we are comparing that if you multiply n number of individual assets, do you get the combination which already has n units of that asset? Is the price same? If not, there is an arbitrage opportunity. Now this is value additivity, right? Now here in this case, in case of dominance, we are looking at two different assets, asset C and asset D, and we are assessing whether their price is exactly the same or different. If it is different, there is an arbitrage opportunity. Now we have spoken about dominance, we have spoken about value additivity. These are all arbitrage opportunities. Even the example that we have taken here, this one, where the bond in one market was selling at 105 and in other was selling at 102, these are all examples of arbitrage opportunities. Now, what do we mean by arbitrage free valuation, friends? Arbitrage free valuation means we are looking at valuing fixed income instruments in a market where arbitrage opportunities are not there. What does it mean? This simply means that same or identical assets are priced in the same way. There is no price difference in terms of markets or in terms of additivity or in terms of dominance, right? There is no difference. And even if there is difference, if you take the transaction cost or the trade costs or the borrowing rates, then that kind of a trade becomes irrelevant or not profitable. That is the kind of situation we are looking at in the markets when we are trying to value the fixed income instruments, right? Binomial interest rate tree. So we were talking about uncertainties of future, right? Let's take an example to understand what do we mean by that. Let's say there is a bond of 3-year maturity. Right now the time is t is equal to 0. We have maturity of 3 years to take into account. 1, 2 and 3. Now right now, let's say the interest is 5%. The interest rate is 5%. We want to assess what is going to be the interest rate at t is equal to 1, t is equal to 2 and t is equal to 3. This is our question, right? Now in case of a binomial interest rate tree, we take into account randomness of future of a certain kind. Of what kind? The randomness is of the kind is of log normality. So what do we mean by that? Let's take our example into account here. So let's say this 5% can move higher also and can move lower also at t is equal to 1. At t is equal to 1, this 5% can go higher than 5% and can go lower than 5% also, right? And also let's say the lower possibility is 4%. So the lower rate which can occur is 4%. What would be the higher rate? Here comes in the application of log normality. In a random movement of numbers or units where the distribution is log normal, in our case, this measure, the higher measure, will be measured like this. The higher possibility of interest rate at time 1 is given by the lower interest rate possibility multiplied by exponential to the power 2 into volatility given by sigma. Now we have to make an assumption of something called volatility. Volatility means what? if there is a current rate of I, how much movement can be there in a certain period of time. So here let's say we assume the 1 year volatility is 15%. The 1 year volatility is 15%. So this implies the higher rate will be 4% multiplied by e to the power 2 into 0.15. Let's calculate the value, friends. The value is coming to be 5.39% approximately. So the higher value is 5.39%. So this is based on a volatility from 0 to 1 of 15%, right? 0 to 1 of 15%. This is the volatility, and the distribution of the random walk is log normal, right? Now let's say from 1 to 2 also the volatility is 15% only, and from 2 to 3 also the volatility is constant at 15%. So we are assuming a constant volatility across the maturity of the bond, right? Now this number 5.39, this one and 4% both have an uncertain future. So the 4% can go up and down, and the 5% can also 5.39% can also go up and down, right? So what are these values? Let's measure, friends. Now let's say the higher possibility for 4% is the same as the lower possibility for 5.39%, right? So this is one rate we have to calculate, and there is a lower possibility for 4% and there is a higher possibility for 5.39%, right? So we have to measure all these values. What will be these values? So friends, let's say the lower possibility for 4% is 3.5%. Now we can easily calculate the middle rate here, because this will be 3.5% multiplied by e to the power 2 into volatility, right? So let's find it out. So the middle rate at t is equal to 2 is equal to 3.5% into e to the power 2 into 0.15, which is the volatility, right? This is equal to 4.72% approximately. 4.72%. So we write down this number here, 4.72%. And because we know this middle rate, we can also calculate the highest possibility, which is the top rate here, right? This one also we can calculate. Here also, this will be 4.72 multiplied by e to the power 2 into sigma, or 2 into volatility. So let us calculate that one also. So the higher rate at time 2 is equal to given by 4.72 multiplied by e to the power 2 into volatility, which is 0.15. Let's find this out. This is equal to 6.37%. 6.37%. So we write the value down here. 6.37%. Now friends, okay, let me do one thing. There is one more timeline where the rates have to be calculated. Let me just rearrange the rate calculations that I have done. So friends, this is the rate calculation at t is equal to 1, and these two are the rate calculations at t is equal to 2. Now we come at t is equal to 3. So friends, we can naturally understand at t is equal to 3, there are total 4 possibilities. How? There is a higher possibility for 6.37 and a lower possibility for 6.37. A higher possibility for 4.72 and a lower possibility for 4.72. A higher possibility for 3.5 and a lower possibility for 3.5. Now, the higher possibility for 4.72 and the lower possibility for 6.37, let's say, are the same. Similarly, let's say the higher possibility for 3.5 and the lower possibility of 4.72, let's say they also are the same. Now we in total have 4 possibilities here. This is 1, this is 2, this is 3, and this is 4. Now we just have to find out these values. First we have to assume the lowest value, let's say. So the lowest value, let's say here is 3%. Here it is 3%. Now the lower middle rate at t is equal to 3 is equal to 3% into e to the power volatility into 2, right? This is equal to 4.05% approximately. 4.05%. Which one is the lower middle rate? Obviously this one, friends, this one. So this is 4.05. Now the higher middle one, this one, also we can find out. The higher middle one at t is equal to 3 is equal to 4.05 into exponential into e to the power 2 into volatility. This is equal to 5.47 approximately. 5.47% approximately. So this is 5.47%, right? Now we have the higher middle rate also. From there we can easily calculate the topmost rate, this one. So as we have already done, these distances are measured in terms of e to the power 2 sigma, right? E to the power 2 sigma. Here also it will be e to the power 2 sigma. So I write the highest rate here. The highest rate, or the higher rate at t is equal to 3 is equal to 5.47 multiplied by e to the power 0.3. E to the power 0.3 means 2 into 0.15, nothing else. So this is equal to 7.38%. 7.38%. So 7.38%. Now, in this way, we have completed our binomial interest rate tree, friends. Through the use of log normality, through the use of volatility, we have completed the tree. Now comes the question, how do we value the bond? How do we value a bond by using this binomial interest rate tree, friends? So let's understand that. So friends, before we understand how is a binomial interest rate tree used to value a bond, we have to understand when is it used. Is it mandatory to use it always, or there are some specific situations where we have to use this, right? Because it is quite complex. So why do we take the hardship of using this? We have to understand the answer to it. So friends, we were talking about arbitrage free valuation. Arbitrage free valuation. Now, in case of an option free bond, the spot rates give us an arbitrage free value, right? The spot rate is sufficient to give us the arbitrage free value. So if it says a 3-year bond, Z1, Z2 and Z3 are sufficient to give us the arbitrage free value. We do not need much else. But the problem happens when there are embedded options. Let's say there is a call option, there is a put option, right? These kind of options are there. Then these spot rates cannot be used directly. We need to take into account the future uncertainty. And therein lies the use of binomial interest rate trees or binomial rate trees, right? So binomial interest rate trees are used mostly in case of bonds with embedded options. But can they not be used for option-free bonds? No, not at all. They can be used for option-free bonds also. But what we are saying here is for option free bonds, we can use spot rates to get the arbitrage free value. It suffices. But in case of bonds with embedded options, the only and only option we have is the binomial interest rate tree. So now we will look at how to use a binomial interest rate tree to value the bonds. So friends, now we learn how to price a bond or find the price of a bond, present value of a bond, when the term structure or the binomial term structure of an interest tree is given, right? Now we will proceed with our existing binomial tree itself, which we have calculated just now. I want you to take a closer look at it and have a deeper understanding of it, friends. Let's understand what these numbers 5%, 4%, 5.39%, 6.37%, all these numbers, what do they actually mean? Where are they impacting? In what timeline is their impact, right? Let's understand that. So this 5% is the rate at t is equal to 0. What does that mean? This 5% basically is the rate for the timeline for 0 to 1. From 0 to 1, this is the rate, right? From 1 to 2, these two are the possible rates, 5.39 and 4%. From 2 to 3, these are the possible rates, 6.37, 4.72, 3.5, these three rates, right? And what is the impact of these last four rates, friends? This is for the timeline of 3 to 4. So if there is a timeline of 4, from t is equal to from the beginning of t is equal to 3 to the beginning of t is equal to 4, these are the rates, 7.38, 5.47, 4.05 and 3%. These are the possible range of the rates. Now using this binomial tree, friends, we will try to find the present value or the price of a bond. Now this kind of a tree, this particular tree is a 4-year binomial interest rate tree. Why 4-year, friends? Because these rates are impacting from time 0 till the beginning of t is equal to 4, right? So this is a 4-year interest rate tree. So for using this interest rate tree, we take or we assume a bond which has a maturity of 4 years. A bond which has a maturity of 4 years, right? Now let's say it has a coupon of 10% of par. It has a coupon of 10% of the par, and par value or future value is 100, right? These are the information that we have. Also, we have information that the coupon is annually being paid. So the periodicity is 1. Coupon is annual. So there are no complications there. And this is, to start off, we start off with an option free bond. Right, friends? These are the specifications. Maturity is 4 years. Coupon is 10% of par. Par value is 100 or future value is 100. Coupon is paid annually. These are the specifications, right? Now we want to price this bond. How do we do that? Let's say the bond that we are considering has a maturity of 4 years. Its coupon payment is 10% of par. 10% of par. The par value or the future value is 100. The coupons are paid annually. That is, periodicity is 1. So M or periodicity is 1. So there are no complications there. And also the bond is option free. So to start off with, we will start off with an option free bond, then complicate the things notch by notch, right? Now we need to find out what is the present value or what is the price of this bond, right? If this is the binomial tree, what is the price of this bond? So let's get started. Now friends, we will write down the cash flows of the bond first. Obviously, when we are trying to find the present value or the price of a bond, we need to know what are the cash flows of the bond at each of the periods, right? So we start with the last cash flow. So the last cash flow is at t is equal to 4. And this is equal to 100 plus 10. that is par value plus the final coupon, which is 110, right? 110 is the final cash flow. Now, there are 4 possibilities of interest rates, 1, 2, 3, 4. So we write this cash flow besides all these possibilities, 110, 110, 110, right friends? Now, at t is equal to 3, what is the cash flow, friends? At t is equal to 3, the cash flow is 10. Right? At t is equal to 3, the cash flow is 10. Now, we write 10 across all the possibilities of interest rates. At t is equal to 2, what is the cash flow, friends? Again 10. Right? So, we write 10 here. T is equal to 1, again 10. T is equal to 0, there is no cash flow. So these are the cash flows, right friends? Now to find out the price of this bond, we will go backwards. So the first step is, for the first possibility of interest, this interest 7.38%, if this is the interest rate, what would be the price of the bond at t is equal to 3, right? So the price of this bond for the highest possibility of interest rate at t is equal to 3 is equal to cash flow at t is equal to 4 discounted by interest rate of the highest possibility at t is equal to 3. This is given by 110 divided by 1.0738. This is equal to, let's calculate friends, 110 divided by 1.0738. This is equal to 102.4399, or I can write 102.44 approximately, right? So the first possibility is covered. This one is covered. Now, for the second interest rate, that is the higher middle interest rate, what is the price? So I can write here, price for the higher middle interest rate at t is equal to 3 is equal to cash flow at 4 divided by 1 plus the higher middle interest rate at t is equal to 3. This is nothing but 110 divided by 1.0. Let me check the interest rate once again, 1.0547. 110 divided by 1.0547. This is equal to 104.29 approximately. So the second one is taken care of. Now we take care of the third one. That is the lower middle interest rate at t is equal to 3. So price for the lower middle interest rate at t is equal to 3 again is fourth cash flow divided by 1 plus the lower middle interest rate at t is equal to 3. This is equal to 110 divided by 1.0405. This is equal to 105.72. Now the last one is price for the lowest possible interest rate at t is equal to 3. This is equal to cash flow at t is equal to 4 divided by 1 plus the lowest possible interest rate at t is equal to 3. This is equal to 110 divided by 1.03, because 3% is the number, right? You can check here. 3% is the number. So all the 4 possibilities have been calculated. Now the value would be 110 divided by 1.03. This is equal to 106.79 or 106.80 approximately, right? So these are the 4 possible values, right friends? Now we do not do anything with these values. We have got the 4 values that are here. These 4 nodal values we have got already, right? Now from these 4 values, we can again derive the 3 values at t is equal to 2. These 3 values. So friends, let me write down this price expressions beside the interest rates. Highest possible interest rate price, middle high interest rate price at t is equal to 3, lower middle price, interest rate price at t is equal to 3, lowest interest rate price at t is equal to 3. So these values we have already taken out. Now our next step is to find out the pricing at t is equal to 2. So there are 3 possible prices, right? Higher price, middle price and lower price, right? At t is equal to 2. P higher at t is equal to 2. So the highest possible interest rate price at t is equal to 2, how do we measure that? Highest possible interest rate price at t is equal to 2 is given by the average of the highest possible price at t is equal to 3 plus the middle high price at t is equal to 3, the average plus the coupon at t is equal to 3. This entire value divided by 1 plus the higher interest rate at t is equal to 2. Let's find out the values, friends. Now, why have we chosen PH3 and PMH3? The reason is simple, friends. See, this particular node has 2 branches, one going out here, one going out here. So we have taken the price here and the price here. It's the simple thing, and we will repeat this for every single node calculation, friends. So this will come to be PH3 is 102.44 plus PMH3 is 104.29 divided by 2, which is the average. This comes to 103.36 plus the coupon is 10. This entire expression divided by 1.0, let me check the interest rate, 1.0637. This is equal to 113.36 divided by 1.0637, 106.57. Similarly, the middle interest rate price at t is equal to 2. This is equal to average of the higher middle interest rate price at t is equal to 3 plus the lower middle interest rate price at t is equal to 3, the average of them, plus the coupon at t is equal to 3 divided by 1 plus the middle interest rate at t is equal to 2. You can easily calculate the value, friends. Now we were finding this one, right? PM2. This particular node is connected to these 2 nodes. So we have used this price PMH3 and PML3, right? So this entire value comes to be equal to 115 divided by 1.0472. 1.0472. It will help if you draw the binomial tree with me, along with me, and put the values in here, right? This is equal to 109.82. Now, in this time zone, that is t is equal to 2, we have one more node left for the price to be calculated, which is PL2. Let's do that. So PL2, or the lowest possible interest rate price at t is equal to 2, is equal to PML3 plus PL3. That is the lowest possible interest rate price and the lower middle interest rate price. Their average plus the coupon at t is equal to 3 divided by 1 plus the lowest possible interest rate at t is equal to 2. This is equal to, let me check the prices. So 105.72 plus 106.80. These two are the prices. 105.72 plus 106.80 divided by 2 plus 10 divided by 1.035. This will be equal to, let's find out the value, friends, 112.33. 112.33. This is the lowest possible price, right? Now we have to find out the higher interest rate price at t is equal to 1. We are looking for PH1, right? Higher interest rate price at t is equal to 1. This node is connected to these two nodes, right? PH2 and PM2. So these two prices will be considered. PH2 plus PM2. That is the middle interest rate price at t is equal to 2 and highest possible interest rate price at t is equal to 2 divided by 2 plus the coupon at t is equal to 2 divided by 1 plus the interest rate or the highest possible interest rate at t is equal to 1. This is equal to, so PH2 and PM2 we can find out easily, friends. PH2 is 106.57 and PM2 is 109.82. So the average is 106.57 plus 109.82 divided by 2 is equal to 108.19. 108.19 plus the coupon is 10 divided by the interest rate, which is 1 plus 0.539. This is equal to 1.0539. You can check here, friends. This is the interest rate that we are talking about, 5.39. So the value is equal to 112.15. 112.15. Now we find out the lower or the lowest possible interest rate price at t is equal to 1. This is the price we are looking for. PL1. This node, this 4% node is connected to PL2 and PM2. So we use these two prices. PL2 plus PM2 by 2 plus coupon at t is equal to 2 divided by 1 plus the lower interest rate at t is equal to 1. This is equal to, so friends, this calculation, as many times you repeat, the better it is. Just create a tree of yourself or use this tree, create this tree in your own copy and calculate the values. Calculate the values. You can change the coupon rate also and calculate a new value, just because it's something new. It's not something difficult. It's just that it's something new that you're calculating. It will take some practicing for you to get comfortable. So get rid of the discomfort immediately by practicing. So PL2 is equal to 112.33. 112.33 and PM2 is equal to 109.82. This is equal to 111.07 plus 10 divided by 1.04. You can check the interest rate here. It is 4% here, right? So this is equal to 116.42. 116.42. Now it becomes easy for us to find out the final price. The final price is P0, that is price at t is equal to 0. So P0 is equal to this 5% node. This is connected to these two nodes. So we use PH1 and PL1, obviously. These two are the only options. PH1 plus PL1 by 2 plus coupon at T is equal to 1 divided by 1 plus the interest rate for the first year. So this is equal to 116.42 plus 112.15. Let's find out. Plus 112.15. The average is 114.28 plus the coupon 124.28. 114.28 plus 10 divided by 1.05. This is equal to 118.36. So our final price is coming to be 118.36 for this option free bond with 4 years of maturity, which gives a 10% coupon on par and is option free, right? So we have done a calculation, friends. Now our next step is to complicate this thing a little bit. Calibrating the binomial interest rate tree with the term structure. So what do we mean by this, friends? Term structure means we are talking about the spot rates, par rates and forward rates, right? Let's say we have the available par rates for year 1, 2 and 3. That is P1, P2 and P3. Small P1, small P2 and small P3. Let's say they are respectively 4%, 5% and 6%, right? Now from this, we can easily deduct the spot rates, right? The spot rates, let's say, come to be like this. 4%, 5.03% and 6.08%. Now, we have a bond which is a maturity of 3 years. We have a bond which is a maturity of 3 years. And we want to do the pricing of this bond by constructing a binomial tree. So binomial tree means there will be the first node at t is equal to 0. Then from here there will be two possibilities, higher rate or lower rate. This will be for t is equal to 1, right? This will be the second node at t is equal to 1. Then there will be node 2 where we will again have a higher rate and a lower rate. And there will be three possibilities here, right? Now, what I want to do is create the binomial interest rate tree for any bond with 3 years maturity. That is, the bond's final par payment or future value payments happens at 3 years. And I want to create a binomial interest rate structure for this, pricing this bond. How do I do that? I can do it, I'm saying I can do it from this term structure. But can I? The answer is yes and no. Yes, because this is one of the criterion that is there, which is required for building this term structure. That is to fill up these values. This is one of the criterion. There are two other criterions. The second criterion is we need a model, the term structure model, along with volatility. Right, friends? We need a term structure model along with volatility. And there is one more criteria. The third criteria is we need a benchmark. We need a benchmark. For example, let's say for the interest rates at t is equal to 1, the benchmark is par bond with a 2-year maturity. Par bond with a 2-year maturity. Why I am saying this, you will understand in some while. Just be with me for now. For the interest rate at t is equal to 2, the benchmark is, let's say, par bond of 3-year maturity, right? In this way, we are going to calculate. Now, these three things together will help us find out this tree, right? Now, let me tell you, the first rate we already have. The par rate, spot rate and this binomial tree rate will be the same. The year 1 par rate, year 1 spot rate and year 1 binomial tree rate all are the same. So 4% we already have. Now we need to find out the other rates, right? Now we will find that out with the Excel sheet and you will understand how the calibration happens. We have said this is the par bond At t is equal to 1, the benchmark is par bond of 2-year maturity. At t is equal to 2, the benchmark is par bond of 3-year maturity. At t is equal to 1, the benchmark is obviously par bond of 1-year maturity. Now this much we know. Now let's go to the Excel sheet and let's see how we calibrate this, how we find out these rates, right? Initially we just assumed some random rate. Now we will understand exactly how to find out the rates. Now friends, we are in the Excel sheet and a few things that we discussed are already here. So time, 3 years, okay. The par rates, as we have mentioned, 4%, 5% and 6%. From this we have derived the spot rates, which are 4%, 5.03% and 6.08%, right? These complicated things, these very complex things are not so complex actually. I'll just explain in a while what these things mean, okay? Now, we have assumed a volatility also. See, in the 3 criteria, the second criteria was a model and a volatility. So we have said that this is going to be a log normal model, right? Log normal model, and we will assume a constant volatility, constant sigma. So here we have assumed the volatility to be 15%, right? And the par value of the bond is considered to be 100, right? So how do we construct? See, here we have already constructed the tree, this tree, right? There are nodes at t is equal to 1 and t is equal to 2. See, t is equal to 1 and t is equal to 2. There are nodes. 2 nodes at t is equal to 1, 3 nodes at t is equal to 2. That's how we have constructed it. Now, what are these things, friends? These are nothing but the benchmark bonds, friends. Benchmark bonds. So, let's check out first. The 1-year par bond. The 1-year par bond, this is basically the benchmark for the t is equal to 0 rate, right? The par rate. Now, why are we saying this? See, what is a par bond, friends? A par bond is such a bond which, when discounted with respect to the par rate, gives a pricing of 100. Now, this par bond is a 1-year bond. See the cash flows. Cash flow at 0 is 0. Cash flow at time 1 is 104. Now, if you discount 104 with respect to 4%, what happens? What is the price? 104 divided by 1.04. The price is 100, friends. So, our first rate is correct. Our first rate is correct. It is 4%. Because at 4%, if we discount this par bond, which has a 4% coupon and par value at future 1-year timeline, this gets priced at 100 in the current period, right? So, we are in the perfect place. So, let me write the pricing here. This is equal to 100 plus 4, which is 104, divided by 1.04. So 104 divided by 1.04. The price is 100. So we are cool with this, right? This is what we have got. Now, the benchmark 2-year bond. The benchmark 2-year bond should also be priced at 100. Should also be priced at 100. This is a par bond, right? Now the par rate at year 2 is 5%. So the par coupons are obviously 5 of par. So this is 5 at t is equal to 1 and 105, which is par plus the coupon at t is equal to 2. These are the cash flows. 5 at t is equal to 1 and 105 at t is equal to 2. Now you can see the tree here. This was the cash flow for the 2-year t is equal to 1 benchmark bond. This was the cash flow for the 2-year par bond. Now this is the tree. This is the tree. What you need to do here is choose a rate here. Choose a rate here. I am writing a question mark so that you understand. Choose the rate here, which makes the value here, equal to 100. How do you do that? So let's start. This is a trial and error method, friends. This is a trial and error method. So let me start with a random value of 5% or 0.5. See, the value is coming close. It is 100.17, but I need to find out a rate here which makes it exactly 100, right? Because the benchmark has to be par. Because the benchmark is 2-year par bond, I need to make this value 100 to get the right rate. So let me increase it a little bit because it's 100.17, right? So let me make it 5.1. Okay, let me make it 5.2 then. So it is less than 5.2. 5.15, no. 5.16, a little bit more maybe. 5.165, let's see. 5.165. Yep. So 5.165% is the rate here, which matches the binomial tree. Now 5.165% is the rate we need here. So binomial tree till t is equal to 1 is formed. Now how have we got this upper rate? 0.069720. Obviously this is this rate multiplied by exponential to the power 2 multiplied by volatility, right? We already know this formula, guys. Let me write it once again. So the higher rate is equal to the lower rate, that is the immediate lower rate, multiplied by e to the power 2 into volatility. We have just used this in the Excel to get the value. Let me show you. This is, see, the previous rate multiplied by exp, which is exponential, raised to the power 2 into E4. E4 means the interest rate volatility, 0.15. So we are done with t is equal to 1 nodes. Now we have to come to t is equal to 2 nodes. We have to find this value, so that the par 3-year bond is priced at 100, right? Let's start doing it. So the coupon for the 3-year bond, obviously for a par bond, it is equal to the par rate, so 106. Now binomial tree, because of multiple possibilities, we have to choose something else, right? Let me choose 0.055. Okay, let me choose 0.06. This is too much. 0.058. This is too less. 5.9. Too less. 5.95. Let me try. Okay. 5.958. Okay. 5.99. Okay. So I've got the number here. 5.99% is the lowest possible rate at t is equal to 2. This is our desired binomial tree, friends. This is our desired binomial tree. These rates have been chosen in such a way that this 3-year tree bond leads to a price of 100 at t is equal to 0. That's how it is. Even for the 2-year par bond, this rate, these 3 rates had been chosen in such a way that this tree leads to a price of 100 at t is equal to 0. So that's how the calibration has been done. So we are sanguine, friends, that this is our required binomial tree, right? This is our required binomial tree. Let us paste it in the board. So here we have it, friends. This was the question that we had. What will be the rates at t is equal to 1 nodes and t is equal to 2 nodes? Because t is equal to 0 node is easy. It's equal to the spot rate or the par rate. So here we have done the calibration hands-on. One thing I need to mention here, friends, is that this is not a mandatory thing for level 2. This calculation is not mandatory, but it is always good to know how the calibration is done hands-on so that you have an idea how these things are done, right? So the 3 things that we have used is, 1 is the par rate or the spot rate, 2 is the model and the volatility, 3 is the benchmark. Benchmark, we have used the par bonds. So these 3 factors we have used to create this interest rate tree. Now we move on to something called pathwise pricing. Pathwise pricing using a binomial interest rate tree. Let's see what we mean by that. Let's say this is the binomial tree that we calculated while doing the calibration, right? This is the binomial tree that we calculated. Let's use this for our example. Let's say there is a bond which is 3 years in maturity let's say there's a bond which is 3 years in maturity and it pays 12% coupon. 12% coupon on par, and the coupons are paid annually. Now we want to find out the valuation of this bond pathwise. So what do we mean by pathwise, friends? You can see the binomial tree here, friends. From this only we can easily understand what is the pathwise thing. So at t is equal to 0, the only possible rate is 4% according to our model. At t is equal to 1, there are two possible rates, 6.972% and 5.1650%. At t is equal to 2, there are three possible rates, 10.9145%, 8.0857% and 5.99%. Now this is how the tree is constructed, right? Now what is pathwise? So what we do here is we consider each possible path from t is equal to 0 to t is equal to 1 to t is equal to 2. We consider each path separately. So what we do here is from t is equal to 0 to t is equal to 1 to t is equal to 2, right? 0 to 1 to 2. Along this timeline, we consider each interest rate path separately. For example, what do we mean by this? Let's say initially the rate was 4%. Then it goes to higher rate of 6.972% at t is equal to 1. From here, it goes to the t is equal to 2's higher interest rate, which is 10.9145%. This is one possible path. So let us write down. Path 1, 4% to 6.972% to 10.9145%. This is one path. What is the second path, friends? Second path can be, initially let's say the rate was 4%, then it goes to the higher rate at t is equal to 1, but then it doesn't move higher, it moves to the lower or the middle rate of t is equal to 2. Now this is another path. Let's write that down too. Path 2, 4%, then it goes to 6.972%, then it goes to 8.0857%, right? Then there is a third path also. What is the third path, friends? It's very easy now. You can understand. The third path can be 4% to the lower rate, then again to the middle rate of t is equal to 2. This is another path. Let's write it down. 4% to 5.1650% to 8.0857%. Now are all the paths exhausted? No, friends. There is one more possible path. The initial rate can be 4%. From there, it goes to the lower rate of t is equal to 1. From there, it moves to the lowest possible rate of t is equal to 2. This is the fourth and the last path. So we write this also. Path 4. This is 4% to 5.1650% to 5.9900%. Now we find out the valuation for each of these paths. V1, V2, V3, V4, and then we find out their averages. This is going to be our pathwise valuation calculation. So let's do it, friends. V1 is equal to, we said the coupon is 12%, right? We said the coupon is 12%, maturity is 3 years, annually paid. Okay. So V1 is equal to 12, which is the cash flow 1, divided by the first rate, which is 1.04, plus cash flow at t is equal to 2, divided by 1.04 into the next rate of path 1, which is 1.06972, right? Plus cash flow at t is equal to 3. This is 112 because maturity comes here. So this is equal to 1.04 multiplied by 1.06972 multiplied by 1.109145. This is the last rate in this path. Now we can easily calculate this value, friends. 12 divided by 1.04. This is equal to 11.53. You can do along with me also. That could be helpful. 1.04 into 1.06972 into 12. This is 10.78. 10.78 plus 90.76. So this is equal to 78 plus 11.53. This is equal to 113.07. 113.07. Now we find out V2. V2 is equal to 12 divided by 1.04 plus, we are now in path 2, right? Divided by 12 divided plus 12 divided by 1.04 into 1.06972 plus, we consider this third rate in path 2, 112 divided by 1.04 into 1.06972 into 1.80857. So this is equal to 11.53 plus 10.78 plus, let's calculate 1.04 into 1.06972 into 1.0857. Invert this value, multiply it by 112. This is equal to 93.14. 93.14. The sum is equal to 10.78 plus 11.53. 115.45. V3. For this we consider path 3. Right? So this is equal to 12 by 1.04 plus 12 by 1.04 into 1.05165 5165 plus 12 by 1.04 into 1.05165 into the final rate 1.080857. So let's calculate it, friends. 1.05165 into 1.04. This is 10.97 plus 1.04 into 1.05165 into 1.080857. Invert this, multiply with 112. This will be 112. 94.74. So the value comes to be 10.97 plus 11.53. 117.24. Now we have the last path, V4. This is again equal to 12 divided by 1.04 plus 12 divided by 1.04 into 1.05165 plus 112 divided by 1.04, 1.05165, 1.0599, I guess. Yes, 1.0599. Let's calculate 11.53 10.97. The last one is 1.04 into 1.05165 into 1.0599. Invert this, multiply with 112. 96.61. The total is plus 10.97. 10.97. Plus 11.53. 119.11. Now we have these four values. 119.11 is V4, 117.24 is V3, 115.45 is V2, and 113.07 is V1. We will take the average of this as the ultimate valuation. So V is equal to V1 plus V2 plus V3 plus V4 whole divided by 4. Let's do that. 117.24 plus 115.45 plus 113.07 divided by 4. The answer is 116.21. 116.21. This is the final answer. Right, friends? So we just demonstrated how to calculate pathwise valuation. Beautiful. Now what we'll do is we'll do something called the Monte Carlo simulation. So let's try and understand what is Monte Carlo simulation. Monte Carlo simulation. How it is done, what are the steps, what are the advantages, what are the disadvantages. These things we'll discuss in this segment, friends. So friends, lastly what we did was we used a binomial tree, right? Like this. Initial interest rate, then at period 1, 2 possibilities, period 2, 3 possibilities. Like this, we constructed a binomial interest rate tree, right? Binomial interest rate tree. Now friends, here we needed 3 things. One was a term structure. Second was a model. Assumption and volatility assumption. And third was the benchmark. While doing the calibration, we understood how benchmarks are used to model the binomial tree, right? We have understood that. Model, obviously we said that we used log normal random walk model, right? So this was a log normal model. Volatility we assume to be constant. And term structure, obviously we use the spot rates and the par rates, right? So these things we use to construct this one. Now for Monte Carlo, there are some relaxations, friends. For example, number 1, the term structure is still there. Number 2, volatility assumption is still there. But in terms of model, we are not restricted to a log normal model, friends. We can choose any kind of distribution that we want. Now, which means we can add skewness to it. We can add kurtosis to it. Right? The skewness means it can be slanted or biased in negativity or positivity. So skewness means it can be biased in one direction. So skewness means the distribution can be biased in one direction. Kurtosis means it can have higher probabilities on the extremities, right? Let me show you what skewness and kurtosis is. This is, let's say, a normal distribution, right? It is symmetric with respect to the mean. Now skewness means this changes. This becomes either like this or like this. And kurtosis means the tail regions increase their probabilities. So instead of this one, the profile can look something like this. right? So there are higher probabilities in the extreme sides. So distribution is one space where there is a relaxation, as we can see. Now, the third is benchmark. Obviously, in terms of benchmark, what we are doing is we are using the spot rate curve. We are using the spot rate curve. Now, how do we use it, friends? Let's say we are looking at a 5-year benchmark bond, right? 5-year benchmark bond, and it has a certain market value, right? It has a certain market value. Now, across all possible interest rate paths that the Monte Carlo distribution talks about, across all the possible interest rate paths that the Monte Carlo distribution talk about, there is a separate price this benchmark bond can have, right? So this distribution basically decides several paths, right? Path 1, path 2, path 3, path 4, path 5, like this. Now, based on each of these paths, this benchmark bond will have a price. That's benchmark bond price 1, benchmark bond price 3, price 2, benchmark bond price 3, like this. All these interest rate paths can give different pricings. Now, we have to ensure, let's say there are n paths like this. N generally in Monte Carlo simulation means 500 or 1000 or 5000, whatever. Now, what we have to ensure is the average of this, the average of all these prices should be equal to the current market value of the benchmark bond. Current market value of the benchmark bond. That is what we have to ensure. So this is more like the calibration that we did in terms of the binomial interest rate tree. The same thing we are doing, what we are doing is we are using the benchmark bond to calibrate the distribution of Monte Carlo interest rate paths. Now the problem is all these paths generated by the Monte Carlo distribution are random, right? So there is no surety that the average value of the benchmark bond when these paths are taken is going to be the market value, right? There is no surety of that. So how do we ensure this? We will understand this by looking at an example and looking at the steps with which the Monte Carlo simulation is carried out. So let's say we are carrying out a Monte Carlo simulation on a bond which is 30 years maturity. It has monthly coupon payments. Right? Now, to value this bond, how many interest rates we will need, friends? We will need 30 into 12 interest rates, short interest rates, right? So 360 interest rates we will need to find one price or one value of this bond. So one single interest rate path will have 360 interest rate values. Interest rate 1, interest rate 2, till interest rate 360. One path will have this, and this will give you a value, right? So let's say we do 500 of these cases. So let's say the Monte Carlo simulation throws out 1000 such paths. 1000 such paths. So like the first interest rate is I11, the second is I12, the third is I13, like this, I1 360. These many interest rates for path 1 only, and this gives a benchmark bond price 1, right? Path 2, let's say the first interest rate is I21, the second is I22, the third is I23. Like this, the last interest rate will be I2360. This will give the benchmark bond price 2. Like this, we will do 1000 such paths. So in the path number 1000, let's say the interest rates are I1001, I1002, like this, I1360. Right? This gives the benchmark bond price number 1000. Now, these are all random numbers, right? Now, these interest rates or these interest rate paths have been created by a certain assumption of volatility and a certain assumption of the model distribution, right? Certain assumption of volatility and certain assumption of model distribution. Now, if we average these values, if we average all these values, it is not at all necessary that the average price will be equal to the market value, right? There is no such necessity. So, to avoid this kind of a scenario where the average price does not equal the market value of the benchmark bond, what we do is we incorporate a drift term. We incorporate something called a drift term. This is a constant value, and this constant term gets added to all these interest rates. That is, all the interest rates in all these paths. We add the drift term to all of them, right? All of them. Whatever I have written here and whatever I have just dotted out, all these interest rates are added with this drift term. Now, what is the objective of it? The objective is the drift term to be selected such that this average price is exactly equal to the current market value of the benchmark bond, right? Current market value of the benchmark bond. So this becomes equal. That is the objective. And once the drift term is added, the distribution is called drift adjusted distribution or drift adjusted model.
Thank you so much, friends, for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships, and CFA curriculum classes, check the description below. Till then, keep watching Finnovation. See you in the next class.